What's good, traders? Welcome back. Today we are breaking out one of the most misunderstood concepts in trading, breakout stretcher. For those of you who don't know me, my name is Zaha Trace. I have been full-time trading for 6 years now, and I currently manage over $700,000 in fanatic capital, and I got 6 figures in payout with the profit. Now let me tell you straight, if you're still staring at charts for 12 hours a day, confused and taking trades that never work out, it's probably because you don't actually understand how stretcher really works. I have blown accounts after accounts the same way when I was starting out, and I would never place a single trade without spotting a proper breakout stretcher first. But here's the problem. Most traders see price break a level and think it's time to buy or sell. Then boom, they get stopped out. Why? Because not every breakout stretcher is villain. Some are just fake outs designed to trap you. And it gets even trickier when the 4-hour is showing one stretcher but the 15-minute is breaking the other way. Which one do you trust? That's exactly what I'm going to show you in this video. The breakout stretcher basic, how to spot a true breakout stretcher, and how to avoid the false ones that keep draining your account. So if you're serious about finally getting funded and profitable, don't just skip around. Watch until the very end, because the difference between a winning trader and a losing one might just be hidden in the last 5 minutes of this video. Let's get into it. A breakout stretcher, or BOS, simply means the market has pushed beyond a previous high or low and closed past it. Think of it like this. In an uptrend, price makes higher highs, higher lows, higher highs, higher lows. Every time price breaks above the last high and closes above it, that's a bullish breakout stretcher. In a downtrend, price breaks below the last low and closes below it. That's a bearish breakout stretcher. But here's where traders get confused. Not every breakout stretcher is filling. A wick poking above a high isn't enough. We need a full body candle to actually close past that level to confirm stretcher is broken. That's what separates the real breakout stretcher from a fake one. Now, breakout stretcher also tell us two things: continuation and reversal. If the trend keeps breaking highs in an uptrend, that's continuation. But if for the first time price breaks the opposite side, for example, breaking the previous low in a bullish market, that's not a breakout stretcher. That's what we call a change of character, or the first signal of a possible reversal. Usually we wait for a breakout stretcher in the new direction to confirm that shift. Now let's connect breakout stretcher with bias. Bias just means, what direction should I be looking to trade in the current session? But how do we know direction of bias by seeing breakout stretcher? It's easy. If the chart shows breakout stretcher to the upside, that's clearly a bullish. If the chart shows breakout stretcher to the downside, that's a bearish, okay? But you might get confused sometimes. On the daily chart, price is showing breakout stretcher to the upside. So you think, okay, bullish bias. But then you look at the 15-minute chart and suddenly price is showing breakout stretcher to the downside. And you're like, wait, Zaha says breakout stretcher gives me directional bias. He must be lying. No, I'm not. Here's the key. Whenever you see opposite signals on different time frames, you always stick with the higher time frame to confirm your directional bias. The higher time frame rules over the lower ones every time. But higher time frame breakout stretcher doesn't mean you take trades directly off it. Instead, you use it to align with your strategy. Think of it this way. Higher time frame breakout stretcher gives you the map, but lower time frame breakout stretcher gives you the road you drive on. When it comes to actually entering trades, you go down to your execution time frame. Personally, I focus on the 50-minute and the 5-minute charts. That's where I'm looking for breakout stretcher to confirm my entry. So this is the workflow. Use higher time frame breakout stretcher daily 4-hour to set bias. Drop down to 5-minute or 15 minutes and look for breakout stretcher in the same direction. Number 3, use that as your trigger to find clean trades. Okay, let's walk through an example step by step. We start in an uptrend, high, low, high, high, higher, low, higher, high, higher, low. Now this move is where many traders get confused. Price pushes up, but then comes back down and closes underneath the most recent low. That candle confirms a breakout stretcher to the downside. We have just shifted from the uptrend into the downtrend. From there, we make a lower high, lower low, and then price reverses again with the strong candle closed above the last lower high. That's a breakout stretcher to the upside, signaling a shift back into the bullish territory. Here's where a lot of traders go wrong. Imagine you are already in an uptrend, price makes another higher high and someone says, look, breakout stretcher to the upside. No, that's not a breakout stretcher. That's just trend continuation. You can just keep calling every higher high as a new breakout stretcher. A breakout stretcher only happens when the market actually breaks the previous stretcher of the opposite direction. So in an uptrend, you don't get a bullish breakout stretcher until price has broken a bearish stretcher. Otherwise, it's just a trend continuation. To break stretcher in an uptrend, you need to see price close below a previous swing low. Until that happens, there is no breakout stretcher, only continuation. Once you do get that close below the low, that's when you officially have a breakout stretcher to the downside. Now let's combine bias and execution. Let's see on the daily chart, daily candle close bullish and 4-hour candle also break stretcher to the upside. That gives me my session bias is bullish. From here, I'll drop to the 5-minute chart. If I see a breakout stretcher in the same direction, that confirms my entry. Now I'm aligned with both the higher time frame and the execution time frame. Let's start with the basics. How do we know what counts as a high? A high is formed when price moves up and then down. Two clear movement. For example, imagine a green candle moving up followed by a red candle moving down. That combination gives us a high. But what about two red candles in a row followed by a green candle? That's just two moves down, not a high. So if you see a wick sticking above the candles, don't automatically assume it's a new high. On the 1-minute chart, maybe it is. But if you're analyzing 5-minute or 15-minute charts, you need to respect the rules of that time frame. Only a proper move up then move down counts as a high. Now let's connect this with breakout stretcher. Once we have identified the correct high and low, the next step is monitoring where the price closes beyond them. Suppose we're in an uptrend. This is the low we are watching. Price wicks below it, but does that count as a breakout stretcher? No, it doesn't. A wick is not a breakout stretcher. Stretcher is only broken when we see a full candle close below that low. Here's another common mistake. Some traders mark the wrong candle as the low, thinking breakout stretcher happened earlier. But when you step back, you realize the real low was formed later. A proper move down followed by a move up. And when the candle finally closed below that level, that's when we had actual breakout stretcher. So even in messy price action, the rule stays simple. Track the most recent high and low and only count a breakout stretcher when a candle body closes beyond them. Now let's go through another example. This time in a consolidation market. A lot of traders get stuck here, so pay close attention. Suppose we have just seen price break stretcher to the upside. Now we're watching to see if it will break to the downside. What do we monitor? The lows. Price moves down, then up. That gives us a low. It moves down again, then up again. That gives us another low. But here's the key. You only focus on the most recent low. Now let's say a wick that pokes below one of those lows. Do we count that as a breakout stretcher? No, we don't. Because we need a full candle closure. A wick alone doesn't break stretcher. Here's a little pop quiz for you. Imagine we had a candle that actually closed under one of those earlier lows. But after that low, a new lower low had already formed. With that, earlier close matter? The answer is no. Once a new low is formed, the old low is no longer relevant. Stretcher is always based on the most recent swing. Don't get tricked by the noise. Stick to the rule of waiting for the candle to close beyond the current stretcher point. What makes a high? A move up followed by a move down. Two candles, that's it. If you just see two bearish candles in a row, that's not a high. If you just see a wick poking above without the proper stretcher, that's not a high either. Highs require an up move, then a down move. Lows require a down move, then an up move. In this example, we had a move up, then a move down. That gives us our high. From there, we start monitoring the low. Price moves up, comes back down, but notice this week that poke underneath. Does that break stretcher? No, because it's only a wick. Remember, breakout stretcher requires a full candle closure. The lesson here is simple. Don't overcomplicate it. Breakout stretcher is just about tracking the most recent highs and lows and waiting for the candle body to close beyond them. Forget the wicks, forget the noise, and just stick to the rule. Move up, then down. So now you understand what breakout stretcher really is, how to define it, how to spot it, and how to avoid the mistakes that confuse most traders. We've gone through the basics, walked through the examples, and broke down how to use the breakout stretcher across different time frames. The main thing to remember is this. Breakout stretcher isn't just a line on your chart. It's the market showing you who's in control. When you start to read it correctly, you trade with clarity and confidence. Now I want to give back to you guys. I'm giving away 5 $10,000 accounts. All you have to do is drop a comment on that video. Not in this video, on that video. That's it. I'll be choosing 5 winners from the comment section, so don't miss out. Comment below what you got from this video. Like and subscribe if you haven't already. I'll see you in the next video. Ciao, ciao.